For the better part of a year, the market really valued AI just on potential. It was all excitement, right? Future hype.
Yeah, absolutely.
But these Q3 2025 earnings reports, they marked a really definitive, almost brutal shift. Suddenly, the conversation isn't just how smart is AI? It's more like, how financially viable is it really?
Exactly. We're seeing what some analysts are calling the great AI revaluation. And, our core mission today is to try and quantify this new great divide.
The divide being
the ability to turn this colossal computing power, the CapEx, right? The money spent on machines, into actual external income, profit.
Okay.
So the question now is just blunt. How expensive is this AI stuff? And how much money is it actually making for the company spending all that cash?
And the answers we got from two tech giants couldn't offer a starker contrast. Let's maybe start with the AI cost center story. Meta.
Right.
I mean, they pulled in strong top-line Q3 revenue, which you'd think would be good, but the stock crashed hard, like 11% to 13% after the report.
And what's fascinating is why. The market basically ignored the current numbers.
It did. So what did they focus on?
They zeroed right in on the future expense warning. Meta signaled that 2026 expense growth, it would significantly exceed 2025.
Wow.
And this was driven by huge infrastructure expansion, that's your CapEx, and, this is crucial, AI talent payroll. Big OpEx jump, too.
So not just machines, people, too.
Exactly. It wasn't just money spent on machines. It felt like this uncontrolled structural OpEx increase. The market treated it as a sign that AI costs were becoming, an uncontrolled force on their balance sheet.
So Meta is being penalized because, they're spending like a tech giant building the future, but they're being valued like, a traditional company with no clear way to make money from that specific investment. Is that about right?
That's precisely it. Investors immediately applied this harsh judgment. See, Meta lacks a clear cloud service business.
Right. They don't sell compute like AWS or Azure.
Exactly. So its massive AI spend gets treated as infrastructure it only uses internally. Analysts quantify this risk using something called the CAPEX coverage test.
Okay. What's that?
It's simple, really. It just asks, how much external revenue are you generating from the huge infrastructure you just paid for? For Meta, because they don't sell compute, that coverage rate is a sobering 0. 0 times.
0! Ouch!
Yeah. It's viewed as a pure faith jump. You're spending billions hoping it pays off internally eventually.
Okay, so if Meta was the big flashing warning sign about the dangers of just spending, Amazon's Q3 results, which came out shortly after, they sort of provided the other side, the explicit AI revenue story the market was crying out for.
That's right. And what's really fascinating here is AWS growth. 20% year over year. That signals pretty attentively the end of that cloud cost-cutting trend we saw.
So CIOs are spending again.
They're moving from just trying to save money back to project investment and those projects. Increasingly AI-focused. But the real aha moment, it was the direct monetization of Amazon's own custom AI chip, Trainium 2.
Right, Trainium 2. The numbers on that look explosive. Showed immediate demand, didn't they?
They really are. Amazon actually disclosed Trainium 2 is now a multi-billion-dollar business. It saw 150% quarterly growth. And get this, it's already fully subscribed.
Fully booked already. Wow.
But the real genius, I think, lies in how they built this kind of closed-loop economy around it, internally known as Project Rainier.
Closed loop. Explain that. Amazon financed its own customer. How does that change the risk on, an $8 billion investment?
Dramatically. Look, Amazon invests heavily in the AI company Anthropic.
Okay.
Anthropic then turns around and pays Amazon millions to rent compute, specifically on the Trainium 2 cluster. So the investment cash Amazon put out, that $8 billion, it never really leaves the Amazon ecosystem.
I see. They created their own locked-in customer.
Exactly. It massively de-risks those huge capital expenditures. It's quite clever.
Okay, so let's connect the dots here. What does this all mean for the big picture? It feels like we've defined some structural winners and losers pretty clearly now.
It means the market has basically settled on dual monetization as the gold standard. Amazon has it.
Dual monetization meaning?
They sell high-margin infrastructure through AWS, right? That gives them external revenue. And then they use that exact same infrastructure, basically at cost, for their own internal empires like retail and advertising.
Okay, so they make money selling the shovels, and they use the shovels themselves for free.
Pretty much. And this means their CapEx coverage rate, remember Meta's was 0. Amazon's is a robust 4.4 times.
4.4? That's massive compared to 0. Just to put that in perspective, what is that number telling investors about how reliable Amazon's spending is?
It's telling them that for every dollar Amazon spends building a data center, they're already generating $4.40 in external revenue from it. That essentially guarantees the sustainability, the stability of their future AI bets. It's why the market rewarded Amazon with that 11% stock jump. They're a verified profit center for AI infrastructure.
And Meta, because they lack that crucial external sales channel, they're just seen as a pure CapEx-heavy cost center.
Right. And we've actually seen validation of this pressure across the supply chain, too. It's not just these two companies.
How so?
Well, upstream, you had Intel confirming that the supply shortage for these specialized AI chips and components, that's going to continue into 2026. That justifies Amazon's pricing power on things like Trainium 2.
Right, scarcity drives price.
And then downstream, you had IT giants like CGI confirming that AI initiatives now account for something like 40% of their new intellectual property income. It proves enterprises are spending real money on this stuff. It's not just hype anymore.
So this great AI revaluation, it really separates companies into this clear, almost three-tier hierarchy.
That's how it looks now. You've got the dual monetizers. They're the kings, like Amazon. Then the pure enablers, the arms dealers, basically like Intel and NVIDIA selling the components. And finally, the pure spenders, the gamblers, like Meta, betting heavily but without that direct monetization loop yet.
A really structural shift playing out in real time.
Yeah, it really is. And this raises, I think, an important question for you, the listener, to mull over.
Yep.
If AI infrastructure supply, we're talking chips, and compute power is truly going to be constrained until 2026, like Intel says, and Amazon is monetizing every bit of capacity almost immediately upon delivery, what's the competitive disadvantage for a company like Meta, a company that is purely a buyer in what clearly a tight seller's market? And maybe more importantly, what impact will that ongoing inability to convert CapEx directly to external revenue have on their relative market cap compared to someone like Amazon over, say, the next 18 months?
Something to think about.